Welcome. Welcome to another episode of Mere Finance and another series. Today we're going to talk about money market funds. And they are extremely attractive in a risk-reward ratio perspective in comparison to banks. Hence, that's why we expect more and more banks to fail over the course of the next week until the yield curve improves. So we're going to explain that, but don't forget to subscribe before. The US nominal yield curve, as of last Friday, May 5th, is here. This is using a constant maturity date, a constant maturity yield. What does that mean? It means in the market, perhaps, there is not a security that will mature in 3 months exactly. So what we do is we kind of extrapolate it and kind of mimic a security that is exactly 3 months, and then we see how much it's going to yield. So you can see here before on the left side, the 1, 3, 6, 9, and 1 year are is very high up to the 9th month. The 1 year is slightly lower than the 20th year. So which means this is why we consider the money market securities. Everything that matures under a year is extremely high, 5% and above for the 1, 3, and 6 month, and for the 9th month is around 4.6. So it's extremely attractive at these rates, because why would you invest at the end of the curve, which is 30 years, 25 years, if you're going to get less than 4%? So this is exactly what's causing all these money market inflows and all these bank failures. And we're going to talk about the risks. So what is the risk in a bank? So the risk in a bank, there is two counterparty sets of risk. One is the bank itself fails. How does it happen? Money, deposits kept being going out the door, and the bank doesn't have enough money to support the liabilities, which are the deposits, so ultimately the bank fails. And on the other side is an asset failure. So the end borrower, so the banks, how they make money is they get money from depositors, then they lend it out. The second part of this counterparty risk is that the assets on which they lend money to, maybe commercial real estate or mortgages or personal loans, fail. So because they fail or they default, they don't get the money back. Hence, the people that have money on these banks won't get the money back because the bank lost that money. So there's two types of risks. The bank failure is more of a bank management. It's not matching asset to liabilities in terms of duration. And the other side, when assets fail, it's basically in terms of default, it's most an issue with asset management, of not picking good projects or good loans on which to invest. So hence that fails. So both are part of the bank. One is in the bank management itself from an operation perspective. The other one is from an asset manager and how banks are investing the money. In the money markets, there is also a risk, of course, but there's only one, is counterparty risk. If the assets that this fund is invested in defaults, hence the money is not repaid, and then the people that invested in the money market, they don't get the money. But there is no bank management risk because there's no operations here that support that bank. There's other types of expenses, but not the ones that you can see in a bank. So how does a money market work? So money market works basically is a mutual fund or an exchange trade fund. It's a fund that invests in securities that mature under a year. And most of them are invested in the repo facility, which we explained 2 videos ago. The repo facility is a facility that the Fed uses, the Federal Reserve uses. So banks can park the money while this is a repurchase agreement. So the banks basically put the money there with the promise that they will repurchase certain securities, and then the Fed Reserve provides a yield on those, which is around 4.85 as of now. Basically, this is default proof because the Fed Reserve is considered to be the best central bank in the world because of the US dollar. So historically, we haven't seen any issues with default because there is no debt ceiling. They can keep printing money. There is no default risk then, and it's basically the lowest risk investment available because it's guaranteed almost that the US government through the Federal Reserve won't fail. So this is why basically there is no default risk in these money markets if they invest in the repo facility or in certain programs that the Fed Reserve have. The reward in the bank. Well, the banks just give you a small interest, but banks have to fund operation costs. They have a lot of employees, they have rent, they have utility, they have licensing, they have regulation. So it's a lot of costs that at the end are being taken of the money that you put in them. So they also, for the last years, they have locked up low interest rate loans in mortgages, in personal loans. You can see mortgages were around 3%. So they are yielding way less than even some money market securities have. So it's kind of hard for a bank to provide higher yield when they're getting interest on their loans from such low levels. And also they have unrealized gains in low yield investments. So in a money market, basically a pass-through entity. How does that work? So they take a small cut in management fees because they are the ones that select which securities they invest while you give them their money. But it's just a percentage, and then the rest goes to the investors. So most of the instruments, as I said before, are short-term duration, so everything has to expire under a year or mature, and they roll up quickly. So say you have a money market fund of 500 securities, 10 of them are maturing tomorrow, then they have to go and find 10 more that mature within a month or 3 months. So the duration of these money market funds are usually constant, so which helps in the management from a risk management of duration perspective. The best money market funds out there are the ones that invested in short-term government money market funds, so treasuries under a 1-year expiration, or those that are invested in the Fed's RRP, so that repurchase repo agreement. So whenever you check at the money markets that you want to buy, just make sure they have broad exposure to the Fed's repo agreement. And how do we fix this? Or how does the Fed Reserve or the government is going to fix this? Well, as we say in the first slide, the yield curve is extremely inverted. There is it's impossible almost to not be tempted and go and invest in the 3-month or the 6-month treasuries or in these money market funds that have exposure to that. So because of this is the black line is the kind of a parameter of the current yield curve. The Fed might need to cut rates because money market rates, which are the ones from the 1 month to the 1 year, are the first one to react. So if you're able to cut rates, then those money markets will completely plummet, hopefully 100 bips. So then it becomes less attractive to invest on them because they are yielding similar yields to anything above 2 years, which is where the money actually should go for long-term growth and for investment. Basically, everything under 1 year should be mostly for cash management. So when a company has cash, they should go into under 1 year as cash management, as ways of securing that cash. But everyone is using now everything under 1 year as actually an investment to provide some yield. Hence, all the money is flowing into those securities. So I don't think it's going to happen. The Fed cannot cut rates when a labor market is so tightened up, when inflation is still there. So what we think is going to happen is we're going to keep seeing banks failing and failing because more and more people are going to the money market yields. And I think the rates in the money market will still be higher for longer, which the more this occurs, the more inverted the yield curve is, and the longer it remains that way, the more the long-term damage to the whole economy. So let us know what you think, and don't forget to subscribe.